The market rallied 566 points on a terrible jobs number. Then it gave back every single point. Same number. Nothing changed between 2 in the afternoon and the close except the market's mind. If that makes no sense to you, the next 8 minutes will fix that permanently, because the jobs report is the most misread piece of economic data in the world, and the people who misread it pay the people who don't. Here is what actually happened on Thursday. US payrolls printed 57,000 new jobs. The forecast was 114,000. That is not a miss, that is a halving. Within minutes, the NAS 100 was up triple digits. Within 2 hours, 566 points. And then, over the rest of the session, the entire rally unwound to the tick. To understand why, you need to know what this report actually is, because it is not one number. On the first Friday of most months, the Bureau of Labor Statistics publishes the Employment Situation Report. It is 2 completely separate surveys stapled together. The first is the Establishment Survey. They ask about 120,000 businesses how many people are on the payroll. That produces the headline number, non-farm payrolls. It counts jobs. One person working 2 jobs counts twice. The second is the household survey. They ask 60,000 households who is working and who is looking. That produces the unemployment rate. It counts people with a different definition from a different sample, because they measure different things. They can disagree, and this week they did, spectacularly. Hiring halved, and the unemployment rate went down from 4.3 to 4.2%. Weak hiring, falling unemployment, same report. Neither number is wrong, and that contradiction, not either number alone, was the most important information in the release. So why did the market rally on terrible news? Because markets do not price the economy. They price the path of interest rates and the path of corporate earnings, and a jobs number feeds both in opposite directions. Channel 1 is the rates channel. Weak jobs means the economy is cooling, which means the central bank can cut rates sooner. Lower rates make future earnings worth more today. That is mechanically bullish, especially for tech. This is the famous bad news is good news trade, and it is exactly what ran the first 2 hours on Thursday. Act 1. Channel 2 is the earnings channel. Weak jobs also means fewer people earning wages. Fewer wage earners means softer demand. Softer demand means weaker revenue next quarter and the quarter after. Somewhere in the early afternoon, the market stopped celebrating the rate cuts and asked a colder question. If nobody is hiring, who exactly is going to buy the products? Act 2. And Act 2 won the close. Now here is the part that separates professionals from headlines. You do not have to guess which act wins. You can watch the assets that only have one channel. Gold has no internal argument on a day like Thursday. Rate cuts are good for gold. Fear is good for gold. Both interpretations of a weak jobs number point the same way. So while equities were arguing with themselves, gold just went up 1.8% and finished the day as the cleanest winner on the board. When one asset has no contradiction to resolve, it votes early and it votes honestly. Short-term government bond yields are the purest rate cut vote. If 2-year yields collapse on the number and stay down, the bond market believes the cuts are coming. If they bounce back within the session, the bond market just called the stock rally a tourist trade. And inside the stock market itself, watch consumer discretionary against consumer staples. If the stuff people want underperforms the stuff people need after a weak jobs print, the market is quietly trading recession, whatever the index is doing. So how do you actually read the report? 6 numbers in strict order. 1. The headline against the forecast and against the 3-month average, because 1 month of this data is noise by design. 2, and almost everyone skips this, the revisions. Last month and the month before get corrected in every release, and the corrections are regularly bigger than the surprise in the headline. A decent headline with big downward revisions is a weak report wearing makeup. 3. The unemployment rate, remembering it comes from the other survey. If it disagrees with the headline, find out why before trading anything. 4. Average hourly earnings, that is the inflation channel. Hot wages plus weak hiring is the worst combination on the card because it argues for slow growth and sticky inflation at the same time. 5. Participation. The unemployment rate falls for a good reason when people find jobs, and for a bad reason when people stop looking. Same print, opposite meanings. 6. Diffusion. How many industries are actually adding jobs? A headline carried by 1 or 2 sectors while everything else cuts is a much weaker economy than the number suggests. Then the final discipline, and this one is behavioral, not statistical. The first hour reaction is positioning. The close is conviction. Thursday's first hour said rate cuts. Thursday's close said recession risk. When those two disagree, the close is the one telling the truth about where the market actually wants to go. And the gap between them is where the next week's volatility lives, which brings us to right now. That 57,000 print is still undigested. Markets were closed Friday. The argument between Act 1 and Act 2 gets settled starting Monday. And there are 2 referees on the calendar, the central bank's meeting minutes on Wednesday, which will show how far the committee was from cutting before this number existed, and weekly jobless claims on Thursday, which after a print like this stop being routine and start being the single fastest confirmation or rejection of the deterioration story. 8 minutes of reading the internals properly. That was the difference this week between understanding both moves and being run over by the second one. The full written guide with the complete checklist and this week's report worked through line by line is on the site, linked below. Education, not advice. Markets carry risk. Manage your size and do your own research.